Sometimes it works that way. Yeah. That's fine. Know how it works.
I want to welcome everyone to FarmFest 2022. You're here for the best part of the morning, certainly. We got a great day planned today. Following our opening program this morning, we got candidate forums this morning. 1st District congressional candidates at 9:30, 2nd, 6th, 7th, and 8th candidates at 10:30. Linder Farm Network noon show from noon to 1. And then at 1:15, we got a great panel of national ag leaders talking about the new farm bill. So a great first day. Kicking us off here is the Kent Beadle, who's the Director of Producer Brokerage with CHS. And Kent's been with us a number of years here. And his title is Market Disruptors of 2022. And certainly it doesn't matter whether we're talking grain markets, livestock, stock market, a lot of disruptions, a lot of volatility. So take it away, Kent.
All right, thank you, Kent. Appreciate it. It's great to kick off FarmFest on behalf of CHS. Appreciate everyone who is here, and look forward to talking a little bit about today's topic, which is the major disruptors that we have right now impacting our grain markets, and there are a number of them. And so we're going to talk a little bit about inflation today, some of its root causes, a possible oncoming recession as a result. We're going to talk a little bit about the Russian invasion of Ukraine and its impact on world grain balance sheets. And we're going to talk a little bit about some of the recent government regulations around renewable fuels, oftentimes at a state level, that has changed our soybean world for a significant, in a very significant way, tightening up our soybean oil balance sheets and providing an awful lot of crush margin and providing much higher soybean prices for U.S. farmers. So, to begin, I want to talk a little bit about inflation and what's going on there. Current CPI this month was just released at over 9.1%. That is the largest inflation rate that we have seen since the 1970s. And obviously, the Federal Reserve ultimately had to move in order to do some things about that. So we've seen a couple of 3/4 point interest rate hikes in the last couple of sessions of the Federal Reserve, which followed a 1/4 point hike and then a 1/2 point hike. So we have already significantly higher interest rates, which clearly have some impact on farm finances. What are the causes behind some of this inflation that we've had? Well, a lot of this stems back to the impacts of COVID. And COVID had impacts in many different areas in the farm economy and in the U.S. economy. Most impactful at the beginning was its impact on labor. And when COVID hit in early 2020, that forced many people to leave the workforce. Some of them left the workforce voluntarily because they were fearful of COVID. Some folks left the workforce involuntarily because their businesses closed. And a lot of baby boomers ultimately accelerated their retirement as well. And so what we had is a huge contraction in the number of people that were willing to work. We also had significant amount of government payments that were going out into the society as a whole, and that made it easier for people not to work. The net effect was a lot less workers during this pandemic, And as a result, it required much higher wages in order to get people to entice to go back to work. And that put even more dollars back into the economy. We also had huge impacts from COVID on our supply chain. So with less workers, you had less manufacturing occurring, you had part shortages, you had chip shortages, you had backups of containers at all of the major ports in California and on the East Coast. You had huge disruptions in China as well, and other manufacturing areas around the world, because this wasn't just a US issue, this was a world pandemic. And because we are so reliant on manufacturing and transportation around the world, our supply chains really got messed up. We have been working in what was called a just-in-time supply chain mindset. Everything moved, everything was expected to move and be there exactly when it needed to be there. And when that didn't happen, that caused huge impacts on our supply chain so that we couldn't buy the things that we needed. At the outset, we didn't have enough toilet paper. Well, we fixed that. But we also ultimately had a lot of other issues with automobiles and trucks and machinery and parts. And ultimately, that drove up the price of a lot of these things that we rely on because you just couldn't get them. So now you have labor prices going up, and you have industrial prices going up. Then it spilled over to commodity prices. We had a massive drop in energy prices at the time that COVID hit. How come? Because we were going to use less energy as many people didn't drive and many businesses closed. It was a huge impact on our economy and a huge impact on the energy market. It ultimately resulted in the price of crude oil bottoming out at a minus $40 a barrel. Negative $40 for one brief shining moment. Obviously, we came back, but lots of things occurred when energy prices got very cheap, okay? We happened to have at the same time a huge disinvestment from Wall Street in our energy companies that produce crude oil, that refine crude oil into gasoline and diesel fuel. And that disinvestment was partially because of lower energy prices, but it was also partially due to what's been called an ESG mindset or an ESG investment strategy, which is environmentally sustainable governance. Wall Street took a lot of money out of the energy companies. They responded by spending less money on drilling, less money on production, which was okay at that time because we had less demand for energy. Eventually, all of the economies started coming back around the world, and we had taken some of this production out of, off the marketplace, and we also shifted some of our refinery capacity. In the United States, a number of refineries converted to the production of renewable diesel, which is something I'm going to talk about here in a little bit. And with all of that capacity coming down, as the economy was getting better, gasoline and prices and diesel fuel prices started climbing dramatically. So now you've got labor costs going up, you've got costs of everyday things that manufacturers make going up, and you've got commodity prices going up. And this is where our inflation has stemmed from. What's been the impact on agriculture? Well, high prices have helped margins in the ethanol industry, helped margins in renewable diesel and in biodiesel, which has helped support demand for corn and soybeans, despite the fact that we have high grain prices. Normally, high grain prices impact those margins. Well, they haven't impacted those margins so far. And in fact, soybean crush margins are very high. Ethanol margins have been fluctuating, sometimes much better, sometimes a little bit worse, but in general, that industry continues to do pretty well. We also had a major shift in protein demand. At the outset of COVID, restaurants closed because they weren't allowed to be open. What that did is it moved an awful lot of demand back toward consumer demand for home use, home cooking, home consumption. And that's a trend that's managed to maintain itself even as we've come out of that, out of the worst of the COVID issues. So, restaurants are opening back up, have opened back up, yet there's still a lot of home demand. Essentially, our demand for protein products, for livestock, for beef, for pork, for poultry have all jumped and have been running at near record rates, which in this marketplace means higher prices. So that's allowed for feed demand to hold up very well, because margins in hog production, margins in cattle production, and in poultry production continue to do very well. Now, some other impacts of this on agriculture, we have the supply chain issues and the Russian invasion here as of late, which I'll talk about in a minute. That has pushed fertilizer prices sharply higher. That's a negative for farm income. Another negative has been obviously the high energy prices and the impact on diesel fuel expense. But a lot of this, again, has been offset by high grain prices for growers. So what impact would we see if we do move into a recession? We did a little work on this. There's been about 8 major recessions since 1972. Commodity prices in those recessions had real mixed results. In 2 of those recessions, we actually had higher agricultural prices. In 3 of them, they were steady, and in 3 of them, prices were lower. Bottom line is that we don't think this recession is necessarily going to have any major negative impact in farm gate prices. We think that the general fundamentals, supply-demand fundamentals of our current situation are such that we're not going to have cheap prices unless we can get a couple of consecutive above trendline crops. We're not close to being cheap yet, even if we were to move into a recession. So that's the first disruptor I wanted to talk about. Second is the Russian invasion of the Ukraine. And picture of Ukraine here, worthwhile to note just how big Ukraine is relative to the United States. You can see that it has a reasonable footprint similar to the size of our Corn Belt. It is the 45th largest country measured by land mass. More than 55% of it has arable land. Agriculture employs 14% of their population, but exports out of Ukraine are extraordinarily important. They were worth $27.8 billion in 2021, and 41% of everything that the Ukraine exported was an agricultural product. So, very important. If you just kind of take a gander at this table here, They are between first and sixth in a number of major commodities in production, and they are between first and seventh in the export of those commodities. And these statistics are from 2021, prior, for the most part, prior to the war. A couple of really important ones. They're the largest sunflower exporter, sunflower oil exporter, and third largest in barley and in canola, and fourth largest in corn and fifth largest in wheat. They are major players in the world export marketplace. So if you look at where the war is and where the crops are grown, this is the area with the wheat production. And of course, if you know, the war is primarily in the east and in the south. It was up in the north toward Kiev early on, and the Russians moved out of that area and have focused on the eastern part of the country. At one point in time, they had occupied somewhere between 20 and 30% of Ukraine, and they still occupy significant portions of the eastern part of the country, as well as parts along the south toward Crimea. The corn, a little more concentrated to the central part of the country and the north. A lot of the wheat was exported last year. A lot of the corn is still there. And a lot of that corn actually is sitting in boats at the different ports right now, unable to get out. Acreage in 22-23 fell significantly because of the onset of the war. Sunflowers, they're the number one producer of sunflowers, number one export of sunflower oil and meal. Production going to be down in sunflowers. Canola kind of skews now more to the west, number 6 producer in the world, but the number 3 in world exporter of canola. So between canola and sunflowers, they actually do have impact on our soybean market through the value of soybean oil. Looking at this spring crop production, acreage was down about 30 to 40%, probably closer to 30%. However, there was an awful lot of uncertainty on the part of the farmers whether or not they would be able to keep their crop. Nobody knew how long the Russian invasion would last, or if Russia would actually ultimately end up winning the war. They didn't know if they would be able to sell their crop, if there would be any buyers, given the situation at the ports. The ports are mined, and we still don't believe that the ports are going to be operational for a very long time. Also, an awful lot of farmers have had to leave to fight in Ukraine, and so labor is very tight. Of course, fuel, fertilizer, crop protection products actually rather scarce in that country right now as well, for some of the same issues around the world, but very specifically to them because of their inability to import and their inability to export. So what is the impact of all of this on the world balance sheet? Well, they have managed to be able to export some grain. They have exported approximately 1 to 1.5 million tons of grain per month, mostly via rail through the corridor in Poland. All of the grain going by rail needs to be unloaded at the border and then reloaded into trains in Poland because their track size is different. It's a crazy deal, but it's true. Their current export forecast from the USDA for this year, 24 million tons. We don't think that they're close to that. We're not sure that they're going to be able to achieve that unless they're able to get boats out here very shortly. I'm going to talk about that situation in a second. Corn production for this year, the crop that was planted this spring, is going to drop to about 25 million tons, down from 42 last year. And exports are only forecast by the USDA to be 9 million tons. That's down from the 24 that they had exported this year that we don't think they're likely to achieve. Their wheat production, estimated at 19.5, is down from 33 million tons. And exports, again, down about 8 million tons from a year ago. These are significant amounts of grain that have been available to the world market in the past that are not available today, and and in many cases are going to need to be substituted for by exports from either South America or from the United States. There are other minor crops, by the way, sunflowers, canola, barley. Those crops are going to be down similarly. So I want to touch a little bit on this most recent agreement that you've been hearing about in the media, this agreement between the United Nations, Turkey, the Ukraine, and Russia. This is an agreement that's been pushed by the UN. It's been facilitated by the country of Turkey because Turkey has good relationships with both Russia and Ukraine. Ultimately, the agreement that they came to, there were two separate agreements, one between the UN, Turkey, and Ukraine, another between the UN, Turkey, and Russia. Russia and the Ukraine would not sign the same agreement, okay? The animosity obviously is very high. Why is this agreement actually going to be very difficult to execute? And we really don't believe that this thing is going to happen. First of all, insurance. When a ship leaves a port, it is insured against any number of different types of catastrophes. When a ship is leaving a war zone through a sea that is mined, those insurance rates are going to be exceptionally high. And that, of course, means that the cost to the end buyer is going to be much higher. And that's if the ship owner can get insurance. We have the mines in the Black Sea, and the mines in the Black Sea have been laid both by the Ukraine to try to prevent Russia from getting in, and they've been mined by Russia as a part of an overall blockade to keep Ukraine out and to keep them from going around forces and launching some sort of a naval attack on Russia. So the Black Sea right now has a number of mines, and not everybody knows where all of them are. So if you are a ship captain, or if you're a ship crew member, how confident are you going to be about being able to navigate through all of that? Not very, in my opinion. Now, according to the agreement, Ukraine, knowledgeable people from the Ukraine are going to help lead these ships through the mines. That's great unless somebody makes a mistake. And not every mine is tethered, some of them are floating. So once again, this is going to be very difficult to execute. The quality of the grain that are in the ships in port right now, that corn has been in those holds since February. So a number of months, five, 6 months. And you know, it isn't like grain that's sitting in a bin with air on them, right? It's, you know, potential for deterioration. So you have to find homes for that corn. That's going to be difficult. You have to get the ships out. Now, more importantly, if you're going to get wheat out, you're going to have to get new ships come in, get those ships loaded, and then get those ships led back out again. And while some ship owners may be somewhat anxious to maybe get their ships out of that situation. I'm not sure that a lot of ship owners are going to be signing up to get their ships into port in Odessa and turn around and get them back out again. Okay? So just the availability of freight to navigate that area is going to be difficult. If we are going to get new crop wheat out, it seems as though there's going to be some fight with the Russians to get that, because Russia is already moving combines in from Crimea to try to combine some of the wheat that's been grown by Ukrainian farmers. So you have that going on. And finally, this agreement's only for 120 days. So given all of these issues, getting 3 million tons out on a regular basis, like every week, which is what the goal is, it's just not feasible. It's just not feasible. Bottom line, Ukraine production, 60% of normal. I mean, leaves an awful lot less for world consumers. It's going to be difficult getting that grain out. And I think this is going to keep demand for both U.S. and South American grain very, very strong for the foreseeable future. Now, the final disruption I want to talk about involves state sponsorship of renewable diesel, as well as the transition from electric vehicles or combustion vehicles to electric vehicles, and how this all works together. So I want to talk about renewable diesel for a couple of minutes. Renewable diesel production has been growing rapidly because of what are called low carbon fuel standard programs that have been passed at a state level. So these are not federal programs, these are state programs that originated in California, now are in place in Oregon, and will be in place in Washington at the beginning of 2023, here just 5 months away. There are other states that are giving consideration to similar programs. A low carbon fuel program basically specifies a carbon intensity reduction goal for gasoline and diesel fuel. It's essentially states setting goals to reduce the amount of carbon footprint each and every year, and they are providing credits to refiners who produce these qualifying fuels. The marketplace is allowing for the regulated parties, which are refiners and fuel imports, to purchase credits if they need to, which makes the program somewhat similar to the RIN program that refiners of gasoline and ethanol-based products are currently involved in. Renewable diesel, though, is different than biodiesel that we've had here in the Midwest. Biodiesel is a blend of renewable fuel and petroleum-based diesel, whereas renewable diesel is not a blend. It is strictly refined from soybean oil or other vegetable oil, and it is converted into a fuel that molecularly is exactly the same as the diesel fuel that you can buy that is made from petroleum products. Has a lower cloud factor than biodiesel, making it better in the cold. And if you look at that chart, what you see is that we have an existing capacity that is starting to grow very dramatically based on the new number of plants that have been announced. And there's at least now about a dozen new soybean processing plants that have been announced that are either under construction, are going to open this year, or are in the process of clearing all the regulatory hurdles. So we have a lot of additional soybean refining capacity coming on. And along with that is going to be renewable diesel refining capacity that is coming along with it. What's driving it? Well, it isn't just economics. There are government credits. The credits to the refiner right now are running about 85 cents a gallon. This renewable diesel also qualifies for the current subsidies that are under the current federal renewable fuel standard program, which are a little over $1 a gallon. And so now you're talking about $1.85 to a refiner of renewable diesel, which is almost the same price that it was selling for here about 2.5 years ago. The crush margins are incenting the construction of these new plants. This subsidy for the renewable diesel is creating the demand for the renewable diesel capacity. And the bottom line of this is that the estimates are such that it's possible that we may need 10 to 20 million more soybean acres by 2024. Now if you take a look at this chart here, which again, it's a similar chart talking about the projected growth of renewable diesel. It's projected that we may need to have 40 million pounds of soybean oil in the calendar year 2024 in order to hit this target. Currently on the 22-23 balance sheet, the USDA has production at 12 million. So you're talking about somewhere in the neighborhood of 3.5 times the soybean oil will be used for diesel than is currently in the current balance sheet. So this is huge. I have a chart here of board crush, and historically, board crush, which is the amount that a soybean processor can get for crushing a bushel of soybeans, it has a tendency historically to run someplace between 60 or 75 cents up to about $1.25. $1.25 used to be really good. We spent very little time above $1.50, and we hardly ever got above $2 a bushel, but we're now consistently above $1.50 a bushel. All the way out the forward curve right now, we're $1.30 to $2.20. So there is huge, huge incentive for soybean producers to crush beans. There is a lot of demand and new demand coming for soybeans. Finally, want to just talk a little bit about how this fits in with ethanol, because you all hear about electric cars and how this is potentially a negative disruptor for the corn industry. Some facts. We've got about 290 million cars and small trucks on the road today. We sell about 17 million new cars and trucks every year. In 2021, only 4% of the new cars sold were electric. Now, the Biden administration has a goal that by 2030, 50% of the new cars they want to be electric. Now, that's a very aggressive goal. It's not one that we necessarily think is attainable. However, Detroit is trying to get there for ESG, climate concerns, and the like. But we see a few issues with it. A couple of things you need to understand if this happens. If we can get to 50% by 2030, where that means we're still going to be selling 50% internal combustion engine vehicles, and those internal combustion engine vehicles will be on the road until 2042 based on the average life of a vehicle, which is 12 years. If the administration could get 50% of the cars sold in 2030 on a straight line between now and 2030, in 2030, we would still have 84% of all of the vehicles in the United States would still be internal combustion vehicles burning conventional gasoline blended with ethanol. So while we're very concerned, people have reasons to be concerned about the future of the ethanol industry, there's a very, very long tail in terms of the demand that we're going to have for ethanol going forward. And we probably have a few issues left yet to solve, including the source of the battery component base metals that you need to make these batteries, many of which are housed in China. You might hear that we've got some issues with that. What is the source of the energy powering these batteries? That's, is it all really going to be green, or are we going to burn something to do it? How are we going to dispose of all of these batteries? If you've ever seen one, they're not small. So what environmental issues are going to be around that? So I suspect that over time we're going to solve these issues, but while that is occurring, we're going to have, as I say, a very long runway for ethanol demand. And all of this is happening at the same time that we're going to have more and more demand for soybeans and need for soybean acres. So we have one more little item, and that is renewable aviation fuel, and that's coming as well. Right now, a voluntary effort by the industry is to reduce its carbon footprint. I'm talking about the aviation industry. The first flight with renewable aviation fuel occurred last year on October 13th between Chicago and Madison, Wisconsin. And it could be, it's made from soybean oil, could be made from soybean oil, but it also could be made from corn. And again, this could be significant incremental demand for corn and soybeans. So as we worry about some of these issues, there are other issues that are very supportive for agriculture in the long run. Now, I don't have time to talk about all these other disruptors, but we have government regulations on water, on fertilizer, on crop protection. I could go into and talk about some more of that. Certainly, we have ongoing geopolitical issues, and if you've seen the market the last 2 days, the marketplace itself is not particularly impressed with the idea that Nancy Pelosi is going to go to China. Now, I'm not going to talk about whether it's a good idea or a bad idea, but the markets don't like it, and those are the kinds of things that we have to navigate as we're trying to market our crops in this environment. Bottom line, uncertainty is high. It's always been high, and it's likely to be high going forward. So I had 40 minutes with a little bit for questions. If there's any questions from the group, I'll take it, or otherwise we'll let Kent get ready for all of the congressmen here. Any questions from the group? Yes. Fertilizer supply for this fall. It's a good question. We think there will be enough. We think it's going to end up being priced reasonably high. Fertilizer prices came down dramatically from the beginning, the first price reaction to the beginning of the invasion of Ukraine by Russia. They shot up. We were looking at $1,500 to $2,000 for anhydrous, and urea prices were up in the $800-900, pushing $1,000. We're still seeing futures prices for urea this fall at now down to about $575 to $650. So they're off dramatically from where they were. Implies that we're likely going to have enough. We think that there will be enough, but it's going to be priced sort of under these new parameters, with a certain amount of Russian production just not being available to the marketplace. Some other questions? All right, well, I want to thank everybody for your time and for your attention and for being here. Thank you very much.